think we are on. So at Hanyang University, it's called the Finance Economics. Okay? Again, I didn't make the title, okay? But in most of the business schools, this course is called the Corporate Finance. Okay? Corporate Finance 1 and Corporate Finance 2. Okay? And so the objective of this course is to provide basic understanding of corporate finance and financial markets. Okay? So corporate finance means how they operate businesses, business corporations, okay? And especially the financial side of the corporations. Okay? So according to our chapter, we're supposed to talk about these things. First of all, basic introduction to business. Okay? There are three primary forms of business. Okay? Sole proprietorship, partnership, and corporation. And this classification is based on number of owners. Okay? Number of owners. Okay? And these are primary classifications. There are more detailed classifications, some in-between cases. Okay? But let's just start out with this primary forms of business. Okay? First of all, sole proprietorship means owned by one person. In terms of numbers of business, this type of business represents 75% of the U.S. businesses. So out of all the businesses, number of businesses, let's say about 75% of the businesses in the United States are sole proprietorship, owned by one person. Okay? But in terms of revenues, total sales revenues, okay, they account for less than 6%. So in terms of total revenues, okay, I would say about this much, 6%. So what does it say about this form of business? What can you tell? Yeah, they don't make much profit, or even before we talk about profit, we're talking about total sales revenue. Right? Sales revenue is so small. So 75% of the businesses make only 6% of the total sales revenue, right? So what that means is, yes, that's right. So sizes of businesses are pretty small. And after all, we're talking about one person owner business. Many times they call it mom and pop business. Small restaurants. Okay, in Korea, you see a lot of chicken stores. Yeah. We're talking about that kind of businesses. Yeah. There are some advantages and disadvantages of this type of business. Okay. The main advantage is easy to start. Very little regulation, very little paperwork. Okay? So anybody can start this business anytime they like. So it's very easy to start. Okay? And the owner has full control of business. After all, you are the owner. Okay? It's your business. So you can do whatever you want. Okay? You have full control of business. Okay? On the other hand, disadvantages. First, unlimited liability. Okay? You are fully liable or responsible for all the business debt. Okay? In case business goes down, it doesn't run well, and you amass a lot of debt, right? Then you may be required to sell your own house, own car, or whatever you have, right? To pay back the business debt, right? So that unlimited liability. Okay? And it is difficult to raise funds. Okay? I don't know whether you have any experience in running the business. Okay? But when you run a business, I would say more than half of the business task is raising funds. You need money all the time. Okay? If the business is running well, you need money to expand. If the business is not doing well, then you need money to pay all the suppliers and your employees and all the costs. Okay? So raising fund is a very important ability that the manager or owner has to have. Okay? Second form of business is partnership. But partnership is kind of in between the sole proprietorship and corporation. So I'd like to talk about corporation first. Okay? Corporation is on the other end of the spectrum. Okay? The definition of corporation is, again, we're talking about number of owners. Okay? And corporations are owned by many people. Who are the owners of corporation? Nope. CEO is a manager. Stockholders. That's right, stockholders. Okay? So when you buy shares or stocks, those are the ownership of the company. Right? So if you buy one share of Microsoft, you are the, part owner of Microsoft. Okay? All right. In terms of number of businesses, corporations account for less than 20% of U.S. businesses. Okay? So I would say about this much corporations. So in terms of number of businesses, it's relatively small. Okay? But in terms of revenues, it accounts for 90%, almost 90% of total revenue. Okay? So what? About this much. Corporations. So here we got 96%, from 6% to 96%. Okay? So what can you say about the corporations? Right. They are typically relatively large, and they make a lot of money. Okay? A lot of sales. Okay? And that phenomenon is getting more evident and salient these days. You probably heard of polarization in income. Rich people getting richer, poor people getting poorer, right? In many countries these days, you see corporations, especially large international corporations, are doing well. I mean, no matter what happens, we had the financial crisis started in 2008 and lasted a few years. Okay? And that was a terrible time in U.S. economic history. Okay? So they call it Great Recession. Okay? When in long time ago, in 1929 and 1930, there was Great Depression. Right? There was a terrible time. Right? But this time, the last financial crisis is dubbed Great Recession. But even during these times, it's tough times, large U.S. corporations were making historical profit, right? So that's the power of corporation. Okay? Unfortunately, those profits didn't, I guess, trickle down, okay? Or came down all the way down to the workers and the ordinary people level. Well, that's entirely different discussion. Okay? But anyway, you can see the power of the corporation. Okay? What are the advantages of corporation? Limited liability. Okay? So when the company goes down, company declares bankruptcy, owners don't have to sell their houses or cars, whatever, right? What's the limit of their liability? What's the limit of the owner's liability? their shares, right? If you hold, say, $100 worth of Microsoft stocks, what's the price of Microsoft stock? I guess, let's say $500 worth of Microsoft stock, right? Basically, that share becomes useless, trash, okay? So you lose $500, right? That's it. You don't have any more liability, no matter what happens to the company, okay? All right, and then there is ability to raise capital because corporates can issue stocks. They can sell ownership, okay? So that's how they raise capital, okay? And then there's permanency. In terms of life of the company, okay, if it's a proprietorship, a single owner company, right? If the owner dies, that's the end of the business, right? Can it be inherited to his son or daughter? Nope. Son or daughter will have to declare another proprietor, another business, different business, right? So when the owner dies or something happens to owner, right, then that's the end of the business, okay? And that's why it is difficult to raise. It's part of the reason why it's difficult to raise capital if you have sole proprietorship, right? But in terms of life of the corporation, basically the ownership changes hands every day, right? Every day. The stocks are traded in the stock market. That means the owners change every day, right? But the life of the corporation goes on forever, okay? So that increases the credibility of the company, and that's why people would invest, either buy the shares or buy the bonds, okay, of the company, okay? Another important advantage is expertise of professional managers, okay? And this comes from separation of ownership and management. That's another important distinction or characteristic of corporation. There is clear separation of ownership and management. Again, owners are stockholders, okay? Of course, managers can own some stocks, okay? But in principle, they are not the same people. In the case of proprietorship, you are the owner. It's your business, right? And there is no other owner. And typically in small businesses, the owner manages his own business, right? But in many corporations, they can hire professional managers, okay? CEO, president, vice president, CFO, and so on, right? So these people have expertise in business management, okay? And that's another advantage of corporation. What are the disadvantages? Well, this one also provides some disadvantages, okay? It's limited control by owners. Even if you have stocks of a company, there is very little to do in case you want to participate in the management, right? Right? What can the stock owners do? Oh, basically, all you can do is participate at the stockholders meeting, which is held usually about once a year, okay? And you can cast some votes. The number of votes is proportional to amount of stocks you have, right? If you have one share of Microsoft, right, your share of vote will be infinitely small, right? Which means there is nothing you can do, even if you don't like what managers do. Okay? So owners don't have real control of business, okay? And it is heavily regulated. In other words, there are lots of paperwork, a lot of regulation, okay? It takes a lot of time and efforts to start the business. You have to file a lot of paperwork, okay? And you have to satisfy a lot of conditions and rules and regulation. What's the purpose of that? Why did they make it so difficult to start and manage corporations? Any idea? I'm asking, what's the purpose of that? Why does the government get in so much and regulate these corporate businesses? I mean, in the opposite case, the proprietorship case, it was very easy to start, right? And there is almost no paperwork, right?
It is holding a lot of power, so we have to regulate it to make the market to be stable.
Okay, yeah, I guess you can put it that way, right? It's holding a lot of powers. In other words, a lot of people have interest in this corporation because the stocks can be traded publicly. Anybody can purchase the stocks and become an owner, right? And also a lot of people invest in terms of bond, right? They lend money to this company, right? So in order to protect owners and investors, okay, they regulate these corporations heavily, okay? Does it make sense? Okay. Okay. So now partnership. Partnership, as I said, are in-between cases, okay? Partnerships are owned by 2 or more persons. It accounts for about 7% of U.S. businesses. So whatever is left here, that's partnership. Okay, so it's very small in terms of numbers, and it accounts for only about 5% of revenues. Right. So in both the number of companies and the amount of revenue, it's pretty small. Okay. What kind of business is a partnership? Have you heard of any partnerships? Law firms, okay. You tend to hear a lot of what? LLPs, right? After some name, right? It's a limited liability partnership, LLP stands for, right? So a lot of professional occupations like lawyers, doctors, okay, accountants, right? They tend to organize partnership. Okay? So about 5 to 10 lawyers get together, and they create a law firm, and the form is partnership. Okay? And there is general partner and limited partner and associates and so on. Okay? In pure form of partnership, it's called a general partnership. Okay? In general partnership, each partner is fully liable. That's one of the disadvantages. It's unlimited liability for general partner. So if you form a partnership with your friend, and let's say you each invested 50%, right? So, you started with small, say 5 million won, and your friend invested 5 million won and started a small partnership, okay? And then one day you find out that your partner disappeared with all the money, okay? Then you are fully liable, and you're 100% responsible for all the company debt, right? Doesn't matter how it started. Even if you invested in only 10% and your friend invested 90%, if you are a general partner, each person is fully liable, 100% responsible, right? So that's the one of the disadvantages. Okay? So pool of assets and talents, the reason why these professional occupations get together usually and form a partnership is they have slightly different specialties. Okay? Even among the criminal lawyers, there may be some white crime lawyer versus violent crime lawyers. Okay? And among the doctors, they may have slightly different specialties, areas. Okay? So by pulling together their resources and being in one building, they can share, office space, share the support personnel, and basically you are broadening your customer base. Okay? That's the reason for partnership, okay? Typical reason. Okay? As I said, there can be another form of partnership. It's called the limited partnership. Okay? But even in limited partnership, at least one person has to be a general partner, okay? Which means that person is fully liable, 100% responsible for all the business. Okay? But if you are a limited partner, then your responsibility can be limited, your liability can be limited. Okay? But at least one general partner is required. Okay? All right. In terms of life of the business, partnership dissolves when a general partner dies or disappears. Okay? So it's not like corporation. Okay? All right. So let's say. As I said in the beginning, another name for this course is corporate finance. So what we are going to talk about in this course mostly are about corporate form of business. Okay? So how the corporations organize and operate and handle their finances. Right? That's going to be our main interest. Okay? All right, how about the organization of corporation? Okay. Stockholders, who are the owners, they elect board of directors. 이사회, right? Board of directors. Okay. And board of directors elect officers. So they can elect the chairman of the board, CEO, COO, CFO, president, vice president, and so on. Right? So if these managers do well, then there can be some rewards. Okay? But if they don't do well, board of directors can fire and replace management. Okay? Or that's their responsibility. Right? Couple of things about these positions. One person can hold multiple positions. Okay? So in many cases, you hear the title President and CEO. If you look at the business card of somebody, right? That person can be President and CEO. Right? It used to be a lot of people had the title of Chairman of the Board and CEO. Right? So, many times businesses start as a private company, family-owned business, and then they go public, right? And so even after going public, which means they sell stocks to general public, outside their family, okay? This family can retain, quite significant portion of the total stocks, okay? So usually the family member hold the chairman of the board and the president or CEO position together, right? These days, those things are not recommended. They are advised against. Okay? So these days, we'll talk about it in a few minutes. Okay? But so you see rare and rare cases of those things. Okay? Because, I'll talk about it later. You don't have this chart on your notes, because this is in your textbook. You don't have to print it, right? But this is typical organizational chart. And of course, different company can have slightly different organizational chart. Okay? But this is a very typical organizational chart. Okay? CEO and VP and so on, right? And our interest in this course is probably starting from here. Vice President for Finance, CFO, right? And then typically controller and treasurer, okay? As you see here, if you look at these detailed functions here, controller's jobs are mostly accounting and taxes, okay? Accounting and taxes, okay? And treasurer's jobs are mostly handling the cash and credit management, okay? So by being a professional in financial field, I guess you will be able to be one of those, the titles. I mean, VP of Finance or CFO, or maybe you should start working in this field. Okay. Okay. So talking about a little more details in career opportunities in finance. Okay. Well, these are the jobs you can think about, I guess, after the graduation, or places of work, right? Corporate financial managers, or getting jobs in these institutions, commercial banks, security brokers, investment banks, mutual funds, pension funds, and so on. A little side item here is about the pension. You know, I lived in the United States for 30 years and came back about 1.5 years ago, okay, to Korea, and I heard a lot of pensions. Okay. And I realized that they call vacation houses or rental houses pension. Okay. So that's something that you never hear in the United States. Okay. And I learned that I guess that the origin of the word is French, pension, or Italian language, pensione. Okay. So but when we say pension in English, we're talking about retirement account or retirement fund. Okay? Something that you save for your retirement. Okay? All right. Well, if you want to move on to these positions or these jobs, these career opportunities, typically some professional certificates are required. Okay? CPA is one, but CFA or CFM, something like that. Then certified financial manager or accountant or something like that. One of my former students dropped by today, and he says he's working on FRM, financial risk management, something like that, right? And yeah, I think it's something that you can think about, right? I believe this college has special classes for those in 금융 고시반, right? Yeah. So you can think about it. These positions typically require some understanding in accounting and economics, in addition to finance. Okay? So in addition to what you learn in this class, you'll probably have to have some courses in accounting and economics. Okay? Any questions so far? No. Good. I don't mind interruption, so you can ask question anytime. Okay? Okay? Good. All right, now we are moving on to a little bit more technical side of this chapter. And we're supposed to talk about goal of a business. Okay? And you know, I'm an economist. I teach economics courses and finance courses. Okay? And yeah, depending on what course I teach, I say different thing. Okay? In economics, when we discuss, you know, especially managerial economics, goal of a business. Does anybody know what's the goal of a business in economics? What? Yeah, go ahead. Just profit? Profit maximization, right? That's the goal of a company or business in economics, right? But when I teach finance, I say different thing, right? In finance, it's called the shareholder wealth maximization. Okay? Slightly different concept, right? But not exactly the same. Okay? I'll talk about it in a few minutes. Okay? So what do we mean by shareholder wealth, or SW in short? Okay? It's calculated by multiplying number of shares outstanding by the market price per share. Right? It's a pretty simple concept, right? And the goal of any financial manager is to maximize the shareholder wealth. Okay? Not only that, we have one more concept here. Okay? Financial managers should seek to maximize the present value of the expected future returns, okay, to the shareholders. So, again, the shareholders are owners of the company, and managers, whether you are a CEO or CFO or VP or whatever, right? Your goal should be to maximize the shareholder wealth of your stockholders. Okay? But more exactly, you have to think about the present value of the expected future return. Okay? There are many principles in finance. Okay? But one of those principles is $1 today is worth more than $1 tomorrow. Do you agree? $1 today is worth more than $1 tomorrow. Why? It's the same dollar or same 만원, right? What makes it worth more today than tomorrow? Inflation, okay. Could be. I mean, if you are living in a country with very high inflation, that's certainly a concern, right? Because inflation means purchasing power of money goes down, right? So real value of the money declines in the future, right? But there's another reason. What is it? You can use it. Or if you use it, it disappears today, right? So what does it matter whether you use it today or tomorrow or a year later? Okay, right? Yeah, you're partly correct. You can use it to invest, right? You can purchase something like stock or whatever, right? Or you can just put it in the bank, right? What happens if you put money in the bank? Right, you earn interest, okay? So that's usually the more important reason why we say $1 today is worth more than $1 tomorrow, right? Because you can invest today, and tomorrow or a year later, it will be worth more than $1. Okay, it's interesting. Let me know, right? Okay. So this is what I talked about. Is maximizing profits the same as maximizing shareholder wealth, right? In other words, what we teach in economics, is that the same thing as what we teach in finance, right? The answer is not exactly, right? Unfortunately, I mean, even though I'm an economist, I should say what we say in finance is a little more accurate or more detailed, right? than we teach in economics. Well, economics is, I guess you can say, it's a basic principle. And what we teach in finance is a little more practical and realistic in this sense. Okay. All right. The profit in economics, we usually use Greek letter pi for profit because we use P for price. Right? Is total revenue minus total cost. Okay? So total amount of money you receive by selling whatever you produce, okay? Minus the total cost, the amount of money you spend to produce this thing, right? The difference is your profit. Okay? So that's what what we say in economics. Okay? But that ignores a couple of things. First thing is profit maximization lacks a time dimension. Okay? Again, we're talking about time value of money. Okay? Money now is worth more than money later. Okay? The same amount of money. Okay? So we need to consider the time value of money, and that's topic of chapter 5 in this course. We're going to learn exactly how to convert future expected income into present value and so on. Okay? Number 2 is GAAP, GAAP. It stands for Generally Accepted Accounting Principles. Generally accepted accounting principles. Okay? It's just accounting principles. Accounting. Well, I don't know what they call it in Korea, but it's accounting principles, and it's the standard, typically standard in many countries. Okay. And if you are an accountant, you have to learn this thing by heart, okay? And you have to go by these rules, okay? How to treat the profit and so on, okay? According to the accounting principles, there can be many different definitions of profits, okay? Of course, there can be total profit, which is total revenue minus total cost. Okay? But many times in financial statements, they talk about rate of profit. In other words, percentage, right? What's the profit rate? How much profit are you making? Are you making 10% out of your investment, right? Or are you even making negative profit in percentage, right? Another name for this is ROI. It's a topic of chapter 3, okay? When we say financial statements, okay? Return on investment, okay? So we're talking about, compared to your investment, how large is your return, right? Are you making 5%, 10% return on your investment, okay? That's another concept of profit. Okay? Another popular form of profit in finance is EPS, earnings per share. Earnings per share. Okay? So in other words, company made, say, $100 million profit, $100 million profit this year. Okay? But what matters is how much of this goes around to each owner, right? Because there are so many owners for corporation. Okay? So if you have, say, 100 million shares outstanding, earnings per share is $1, which is not really bad. I mean, usually corporations report their earnings quarterly, every 3 months, right? And in many cases, if you make $1 profit per share, That's not bad, right? So, you know, you can measure profit by EPS, earnings per share, right? And there are many, many other concepts of profit according to accounting rules, accounting practices, okay? All right, so we need to be more specific and more practical rather than just simply saying profit maximization, okay? Another problem with the simple profit maximization is it does not consider risk, okay? Risk is a very important part of financial operation. Let me give you one more principle of finance, okay? The risk and return go together. Risk and return go together, right? In other words, if you want to make a lot of money, you have to take a lot of risk. There is no other way. Why? I mean, why can't you make a lot of money by, without taking a lot of risk? In simple terms, I'm not asking for any financial theory here. In common sense level. That's right. If it was so safe and easy, everyone would have done it, right? So it's in more complicated term, it's called the efficient market hypothesis. So what that means is, in theory, you know, whatever information is available out there, it's already considered. If you look at the stock price of Samsung tonight, whatever the price comes out to be tonight, it incorporates all the information up to now, right? Including Ukraine, Crimea, the peninsula situation, okay? So it's already incorporated, right? So it's hard to make any unexpected and extra profit out of buying these stocks today or tomorrow, right? Well, of course, unless you have some inside information, right? Something that other people don't know, right? So what that means is if you want to make high return, you have to take more risk, okay? All right, but in typical economics calculation of profit, risk is not considered, okay? All right, let me make just one comment before I let you go. This GAAP, as I said, this used to be a lot of standard in many countries, accounting standard in many countries, but it is changing. It's called these days IFRS, International Financial Reporting Standards. So GAAP, a lot of countries are converting GAAP into IFRS, okay? International Financial Reporting Standard, okay? The reason is, of course, a lot of businesses are now international, okay? So if you have your businesses in many different countries, okay? If each country has different accounting standards, it's hard to understand how they are doing, the business is doing. And if you're trying to acquire another business in other country, if two countries use different accounting standards, it's hard to figure out whether the company is doing well or how much the company is worth, right? So we're trying to internationalize the accounting standard, okay? Finally, the reason why we prefer shareholder wealth as the goal of financial analysis or financial managers here in this course is simple profit maximization that we teach in economics, okay? Does not consider the risk, okay? In other words, sometimes there is conflict. You can increase the profit at the risk, at certain risk, okay? You know, in other words, you can simply borrow more money, when you have a certain project, okay, and you can increase the profit, okay, and you know, in terms of depending on how you define the profit, you can increase the total profit, but when you increase the profit at the cost of increased risk, then that may not be good for shareholders' wealth. That may not be the best for shareholders. Okay. As we go on in the semester, I think you can understand more exactly what we're talking about. We will, in chapter 7 or 8, more exactly talk about the concept of risk and how to bring the concept of risk into the financial analysis. Okay? So let's go on. Let's move on this time. Okay? So more exactly, how is the maximization of shareholder defined? Ultimately, it depends on the stock price. Okay? Because as we talked about last class, shareholder wealth depends on the stock price. We multiply the total number of shares outstanding by the share price. So that's going to be the total amount of shareholder wealth. Okay? So, you know, the immediate goal and ultimate goal of financial manager is to increase the stock price. Okay? But a CS here stands for common stock. Okay? Common stock. Okay? There are different types of stocks, common stock and preferred stock. We'll talk about that later. Okay? But basically, the common stock price depends on three things: the amount of cash flow or expected cash flow, and timing of cash flow, and the risk of cash flow. Okay? So a little bit early, but let me give you this formula. T goes from 1 to infinity. Okay? And this is the formula that we use to calculate the value of a stock or price of a stock, okay? Or conceptual price of stock. Well, we have two different concepts of stock price. Okay? The market price. Market price is determined by supply and demand in the marketplace, right? But essentially, what determines the value of any stock, right? We consider this formula. Okay? D is dividend. What is a dividend? Anybody? You don't have to say it exactly, but what is the concept of dividend? Right. Did you say payments? Yeah, payments to shareholders, right? Or just simply share of profit. Okay. So when a corporation makes profit, okay, well, the profit is supposed to be shared by owners, shared among the owners. Okay, and of course owners are stockholders. Okay. So when the amount of profit is divided and paid to each individual owner, it's called the dividend. Okay? Now, T of course stands for time, each period. Okay? Typically, corporations make the dividend payments every quarter. Okay? Typically, they don't have to, right? So we're talking about the summation of future dividends. Okay? But since we're talking about payments that happen in the future, we're going to discount it. This is the subject of chapter 5 when we discuss time value of money. Okay? So we are bringing the future values into present value, okay? So that we can make the financial decision right now. Okay? All right, so here the amount of future cash flow is reflected in the concept of dividend here, amount of dividend payments. Okay, and the timing of expected cash flow is brought in this concept of time. Right, we're making a summation of all the future cash dividends. Okay, and discounting them into current period, into present value. Okay, and then the risk of expected cash flow is reflected in K. Okay, this K is interest rate, essentially. Okay, or you can call it discount rate, but it's the same thing as the interest rate. Okay, and the discount rate depends on the amount of risk, depending on how risky this stock is. Okay, if you are going to invest in more risky stock, right, then you have to expect higher return. You have to be compensated by higher return, right, if you take more risk. Okay, so basically K is determined by the amount of risk. Okay? So there are three factors that determine the shareholder wealth. Okay? And here we talk about different stakeholders. Stakeholder is different from stockholders. Okay? You know what stockholders are. Okay? But stakeholders, I guess you can say stakeholders are people who are involved in or affected by a business. Okay? So let me define the stakeholder. People who are involved in or affected by a business. It could be a business. Well, for our course, I guess more relevant concept is business. But it doesn't have to be business. In any organization, there are stakeholders. Okay? You know, if you go to camping, what does it look like? Tent. Oh, yeah, very good. Guess I went to a good kindergarten. When you pitch your tent, what are these things called? Peg. You can call it peg or stake. Right? You know, the stakes are the basically the poles that hold or support this structure, this tent. Yeah? So stakeholders are the ones that support any organization, or who have vital interest in this organization. Okay? So investors, customers, employees, suppliers, or the member of communities where the firm operates, okay, are considered stakeholders. Okay? I guess we can understand investors, right? If you think about the company, there should be investors. The investors are people who lend money to this company so that they can start the project and continue the project. Okay? How can you say customers are stakeholders?
If the company collapses,
Mm-hmm.
customers cannot buy here products.
Right. You know, first of all, definitely, the companies need customers, right, in order to survive, right? But customers also depend on the company, right? Suppose you bought a car, right? And you're supposed to be able to use the car for a few years, at least, okay? And if the company disappears, then you won't be able to get maintenance after service, okay? So customers are important part, important stakeholder. Okay? Employees, of course, you can't run the business without employees, okay? And employees depend on the business. Okay? Suppliers, if you supply your products to this company, right, then definitely you have vital interest in this company. Okay? And the communities, okay? Because you know, looks like, I mean, probably a lot of employees live within the community, right? And they work for the company and make money, receive money from the company, and then they spend money within this community, right? So their, you know, community and the company are sort of inseparable. Okay. All right. So we have these many different components for this company, or different stakeholders for any business. Okay. But the thing is, these individuals may have different goals. Their interests are not alike, right? And sometimes they may not be consistent. Okay? So the next topic here is agency problem. Okay? Agency problem comes from the divergent objectives of these individual components or stakeholders. Well, let's make it simple. Try to understand the relationship, what we call agency relationship. And the agency problem comes from the different goals or inconsistent goals between the principal and agent. Okay? So if you think about a company, okay, who are the principals and who are agents? We can think of a few different relationships. First of all, creditor versus shareholders. Creditors are the people who lend money to the company. Okay? Well, in chapter 2, we're going to talk about financial markets. Okay? And at that time, we're going to learn more exactly. But there are two different corporate securities. Stocks, bonds. Many times we call this equity, and this is called the debt. Okay. So we talked about stockholders already many times. Okay. Stockholders are owners. And corporation can raise capital by issuing and selling stocks. Okay? But in addition to stocks, corporates also issue bonds. Okay? Well, bonds are simply IOUs or IOU. Okay? So it's a statement that I borrowed money from you, and I owe this money to you. Okay? So, you know, it's, well, in Korean, chekwon, right? So, when the company issues bonds, right, they're taking on some debt. And at some point in time, they're supposed to pay back the principal and interest. Okay? All right, so that's the idea of bonds. Again, this is the topic of future chapter. Okay? So we call bondholders investors or creditors. Okay? So we have creditors who purchased bonds from the company and shareholders who purchase stocks from the company. Right? But unfortunately, the interest and objectives of these two groups of people may conflict, may not be consistent. Okay? Because shareholders, they want more profit, of course, right? And goal of a financial manager should be maximizing shareholders' wealth. Okay? So how can you increase profit? Well, you have to do more and more projects. Right? So let's say, at some point in time, at a point in time, company may have some possible candidates, projects, 1, 2, 3, 4, 5. Okay? And when you do some analysis and evaluate the profitability of this project, suppose you came up with 10 million, let's say, expected profit from each project. Okay, 10 million, say 5 million, 2 million, negative 1 million, negative 4 million, something like that. Okay? We're talking about profits. Right? So after deducting all the cost, you expect to make this pure profit from each project, right? Then, in order to maximize profit, you're supposed to do all the projects that promises to return positive profit, right? That way you can maximize total profit, right? Well, unfortunately, if you take more and more projects, there will be higher risk, larger amount of risk, right? Risk of failure, right? Because there are so many things, so many factors. The economy can go down. The war can break out somewhere. Right? Nobody can expect all those things accurately, forecast those things, right? Well, despite all that, the shareholders will probably want to have more and more project and larger profit. Okay? But creditors may not want that. When the company makes larger profit, does it help creditor or bondholder? Not necessarily, okay? Because stockholders can definitely benefit from larger profit because dividend, right? The total profit is supposed to be shared among the shareholders, right? So they can definitely benefit. But bondholders, what do they get?
Interest.
They receive certain amount of interest. It's a fixed interest, okay? So another name for stocks and equity is variable security, because return from this security changes depending on the amount of profit. Okay? Another name for bonds or debt security is fixed income security. Okay? Because income from bond is fixed. It depends on the contract, initial contract, when the company borrowed money, okay, and issued the bond, how much interest did the company promise, right? So every 6 months, companies typically make that interest payment, okay? And when the maturity comes, they're supposed to pay back the principal. The amount of profit doesn't really matter, right? Well, if the company makes a lot of profit, then you can say it is more secure. The company's future is more secure, and it is less likely for the company to go down or go bankrupt, right? So in that sense, it is good for bondholders, because if the company goes bankrupt, then you may not be able to get your money back, right? But other than that, the larger profit doesn't really help, right? The bondholders, okay? So in other words, bondholders may not want the company to take on more and more projects at the cost of risk, higher risk, okay? But shareholders may want it, right? Here's another relationship that can cause agency problem, okay? That's the stockholders and managers, okay? Who are the principals and who are the agents here? If we are talking about the relationship between stockholder and manager, who are the principals and who are the agents? Who work for who? Whom? Right. Managers are supposed to work for stockholders in order to maximize their wealth, right? So managers are agents and stockholders are principals. How about here? Creditors versus shareholders. Who are the principals and who are the agents? Who? Shareholders are agents, right? You can understand it that way because in this relationship, creditors invested into shareholders or their company, right? So shareholders are supposed to work to make profit and eventually pay back the money to creditors, okay? All right, so here, we've been saying many times that the goal of financial manager is to maximize shareholder wealth, right? So obviously the financial managers are supposed to work for the shareholders, okay? But unfortunately, their goals may not be consistent. How? Well, in theory, managers are supposed to do anything possible to maximize the total wealth of the shareholders, okay? But in reality, managers may have more pressing goal or more important goal for themselves, right? Such as, job security, right? Remaining in job for longer period, right? Well, what do you mean by that? I mean, you're supposed to maximize the shareholders' wealth. If you are successful in increasing shareholders' wealth, then aren't you going to be in your job or maintain your job for a long time or even get promotion or whatever, right? Increased bonus, something like that, right? True, that is true, right? But the thing is, again, if you want to maximize the shareholders' wealth, then you have to take all the risk, right? You have to go through all this, take on this project and try to increase the total profit as much as possible, right? But then there are risks, right? So if everything goes well and if you are successful in increasing the profit, that's fine and good, right? You will get praised, okay? And you may even get bonus, okay? But in case something goes wrong and one project fails, instead of $2 million expected, you lost $10 million, right? Then you may lose your job, right? As a manager, as a president or, CEO, right? Yeah. So many times, managers show satisficing behavior. Satisficing. If you type that word in word processing software, you'll see the red underline, okay? Which means there is no such word. Okay? You have misspelled that word, right? This word is used only in finance, okay? Finance textbook. Okay? Satisficing behavior means seeking acceptable performance rather than maximizing. Okay? So if you work for a company, you see this every day. I used to work for a company, okay? And every 3 months there's a result, right? The sales result, okay? And based on the sales, they calculate EPS, earnings per share, okay? Total profit divided by number of shares, okay? So how much of the total profit goes around for each shareholder, right? And let's say it comes out to be 30 cents per share, right? And do you know what they do with this number? Immediately, they call around and ask around and try to find out what the other company, your rival company, made, right? And if the rival company's EPS comes out to be 0.29, everybody says, good. We are safe, right? So all you need to do is meet or beat your rivals or competitors, right? Because investors who ultimately decide on the performance of the company, right, have no idea. They have no idea what the projects were, how many possible projects were there. Had the management taken all these opportunities, taken on all these projects, how much potential profit the company could have made? Ordinary investors or shareholders have no idea. They don't know what's going on, right? All they see is EPS the company announces every 3 quarters, right? And if the company you have invested has higher EPS than the other company, the rival company, then you have no reason to complain, right? Because you don't know all the details, what's going on, what could have happened. Okay, so that's the idea of satisficing behavior. Okay, managers are risk averse. They don't want to take any risk or unnecessary risk, right? According to the theory, in principle, you're supposed to take calculated risk, right? And you consider all the risk, and if it's still profitable, you're supposed to take on all possible profitable project. Okay? But in reality, managers may not do that, because if something goes wrong, right, then their job security is on the line. Okay? All right. So that's the idea of satisficing behavior, and that's the problem with the agency, called agency problem. Okay? Well, here I inserted a couple of slides comparing the attitudes of managers. Okay? First question is, whose company is it? Is this the company of the shareholders or all stakeholders? Okay? Again, all stakeholders include employees, investors, customers, and suppliers, and the community, right? All those people, right? And you can see some striking difference between these first 3 countries and the last 2 countries. UK and US are pretty similar, right? But 3/4 of the managers in UK and US, they consider it's the shareholders. Okay? The company's owner, this company is owned by shareholders. Okay? But these first 3 countries, Japan, Germany, and France, okay, more than 3/4 of the managers think the company is owned by stakeholders company. In other words, you need to protect the interest of all stakeholders, not just shareholders. Okay? Another graph here shows similar results. Okay? When you ask job or paying dividend, okay? So when the condition worsens, economy goes down, when the company makes less profit, okay? Sometimes you have to choose. Okay? Sometimes you have to choose between paying dividend to shareholders or retaining employees. Okay? Because many times when the company profit shrinks, first thing companies do is laying off workers, right, to save cost and maintain the profit, right? You know what that is, layoff. What is in Korean? Yeah, 구조조정, something like that, right? Yeah. Restructuring. Actually, 구조조정 is restructuring. Okay. But layoff is, letting people go, right? Employees go. Right? So, if you have to make a choice, which one would you choose, right? U.S. and U.K. managers, almost 90% of them choose dividend. Okay? Again, they are understanding of the company is this is shareholders' company. Shareholders are the owners. Okay? So no matter what happens, we have to protect shareholders' interest. Okay? That's the idea of these cases. Okay? But the first three countries, more than half of the managers, well, Japan is an extreme case. They consider job security a lot more important than paying dividend. Yeah? So you can say, I guess, basically it's a contrast between socialism and capitalism. Okay. This UK and the United States are more capitalistic economy, okay? Capitalistic society. I guess Germany, France, Japan can be considered more socialistic. At least the concept, at least the attitude of the manager is socialistic. Okay? All right, so related to these agency problems, what can be done? Okay? Recent years, last 10, 15 years, right? There have been a lot of changes, especially in the United States, and I'm sure in many other countries, about the corporate governance, okay? How to manage a corporation. In order to reduce the agency problem, they recommend this thing. I'm really sorry about this screen. I don't know what happens there. Okay? But well, first thing they recommend is the outside directors or independent directors, 사회이사. Okay? So the directors that are not related to this company. Okay? I mean, traditionally, when you work for a company, you become what, manager and senior manager, and then you're promoted to director many times, right? And these days, they recommend the companies to bring in people from outside as a director, right? Not the people who have come from inside, okay? In order to maintain the transparency. Transparency of the management of the company, okay? Also responsibility. Corporate responsibility and transparency. These are two big words these days. Because there have been some problems in the United States and other countries. Okay? Especially the committee responsible for nominating members of the board of directors, okay, must be composed only of independent directors. Okay? And the post of chairman of the board should be separate from CEO position. Okay? Chairman of the board and CEO. I mean, in the old days, okay, same person used to hold these both positions, chairman of the board and CEO. Okay? Probably the company used to be a private company, and then it went public. Okay? But the thing is, board has this supervising most important function of the board of directors is supervising and monitoring. They're supposed to supervise the management of the firm and the monitor, whether the managements are doing everything right. Okay? And in case they don't like it, in case boards find out that the CEO is not doing the right job, then they should be able to fire CEO and replace the CEO or any other executive members, right? But if the CEO is the chairman of the board at the same time, then it's going to be difficult to do that. right? It's going to be difficult to fire himself, right? So they recommend, the two positions be separated. Okay? And all members of the audit and compensation committees must be independent directors. So, the importance of independent directors has gotten very significant these days. All right, so I guess this is the last slide of the chapter. Other than requiring those conditions or regulatory conditions of the corporation, right? What can they do? Okay? There are a couple of things that are in place. Okay? Managerial compensation. Compensation is tied to the performance, basically. Okay? So in order to bring the shareholder interest and management interest together, again, divergence of the shareholder interest and management interest, that's the source of agency problem. Okay? So in order to reduce the agency problem, you can do these things. Stock options. Okay? When you hire management or executive, you can promise stock option. Okay? So basically, you are giving certain amount of stock, company stocks, to this executive. Okay? And say after certain years, after 5 years, you can exercise this option at certain price. Okay? So the incentive for this executive is to remain with the company long time, okay? Instead of focusing on short-term performance, right? They are, I guess, supposed to focus on long-term performance of the company, okay? And then also to raise the stock price, because the higher the stock value, the option value will be higher. Okay? So by granting some stock options to executive at certain exercise price, you can give incentives to executives to perform. Okay? So, not only look at his own job security, his or her own job security. Okay? The executive is supposed to try to increase the stock price, okay? Shareholder wealth. Okay? Restricted stocks, it's a similar concept, but this requires longer time, like 10 years. Okay? You can exercise these stock options for 10 years. Okay? So that means the executive is supposed to look after the company's interests for long-term interests of the company. Okay? Performance shares, okay? The option is tied to the performance of the company. So, I guess certain periods, look at EPS, earnings per share concept, right? As a measure of the company, or there can be some other measurements of the performance other than EPS, okay? And only if the executive performs as expected, then they will be granted certain benefits, okay? So that's the idea of performance shares. Okay? And then threat of takeover. Threat of takeover is already there, because when the company doesn't perform very much, if the company is not doing well, then first thing you see is stock price goes down, right? And the stock price goes down, it becomes an easy target of acquisition. You know what acquisition is, merger and acquisition, right? So, there are always your rivals or companies try to take over your company if the company has good business, okay? But if the stock price goes down, then it's easy to purchase more shares of the company, right? So low performance gives an opportunity or threat of takeover. Well, what happens to management when the company is taken over? If the company is acquired, what happens to the management? Mostly, many times, okay? Because, when two companies merge together, or company A acquires company B, right? You can't have two presidents, right? You can't have two CEOs, right? So these high-level executive jobs will probably be slashed, okay, or replaced, or eliminated. Yeah. So the threat of takeover becomes, I guess, effective deterrence for executives, okay, to get slack in their performance. Okay. Okay. Any question from chapter 1?